Welcome back, everybody, to the Informed Home Buyer Podcast. I'm your host, as always, Rich Curtis, and I have with me my co-host, Dave Miller. How you doing, Dave?
I'm good, Rich. Good afternoon. Thanks for having me.
All right, folks. So Zillow had previously said we're going to lose at least 1% or a little over 1% in home values by the end of 2025. Redfin has now come out and said, yep, we agree. And we've got Gallup reporting that more than any other time recently, we have an overall lack of confidence in now being a good time to purchase a home. In fact, 72% of Americans think now is a bad time to purchase a home. So do Dave and I agree? Well, the answer is kind of. But in addition to it maybe not being the best moment right this second to buy a home, it is a great moment to get prepared to take advantage of opportunities. We're going to teach you how to do that. We're going to get to that at the end of the show. But as always, we want to lead with the data so you guys can make your own informed decisions. So we're going to start with that right now and run you through some of the numbers as to what's going on inventory-wise, price-wise, and closed sales-wise to give you an idea of how are they coming up with these numbers. Why does Zillow say we're going down? Why does Redfin say we're going down? Why do the California Association and National Association of Realtors say we're not going down? How are they interpreting the numbers, and how should you interpret the numbers? Let's get right into them right now. All right, so starting with the Zillow home sales forecast. Now, if you've been watching our podcast for a while, you might have remembered we did an episode on this earlier where Zillow had said, hey, we're going down 1.9% by the end of the year. Now they've updated and said, oh, just kidding. We're going to go down 1.4% by the end of the year. 1.4% was Zillow's prediction. Now that's a revised prediction. And like I said, we have Redfin starting to agree with them. So let's pull up Redfin. Redfin has just posted that they believe we're going down 1% by the end of Q4 in 2025. So Zillow's at 1.4. Redfin's at 1. Nobody cares about the 0.4. We're in agreement here that prices are trending downward. Now, if you look at the California Association of Realtors, they have not updated their home report. Still says we're going up 4 to 6% in California, and the National Association of Realtors still says we're also going up 3 to 5%, and they're still maintaining their 5 to 25% over the next 5 years, and they're not updating those. Why are they not updating those? Because they know it's a confidence-based market. They know the rest of the media is shaking your confidence with reports like this. Pardon my scratchy voice, folks. Got a little bit of a cold, and they don't want to be part of the narrative that shakes your confidence. Well, I'll punt it to you, Dave. Who do you think's got this right? Carr, NAR, or Zillow and Redfin?
I'm based on the data, Zillow and Redfin. I'm not seeing anything that says otherwise. I think it's kind of what we've been talking about for a few months now, and what we expected. So, I don't know. I think some of these folks come out and they wait to see what the closer to the data before they make a projection. But all the data that we're seeing, and I think what Redfin and Zillow are stating, it's already happening. It's out there. Someone that's has listings, you're seeing it. You're just in the markets that we work in as both a buyer and a listing agent. You're seeing what's happening. This is accurate, and at least in with what the data is showing.
Yeah. And now, trust me, folks, anybody in the real estate industry is very reticent to agree with Redfin and Zillow. They are not our favorite people out there. They're not our favorite players in the industry. They're not right on their estimates. Watch out for those. But in this case, we got to give credit where credit is due. They've got it right, and the trade associations will be forced later in the year to come out with some accurate predictions. They're just dragging their feet until there's no other choice but to acknowledge the financial realities on the ground. But I believe Zillow and Redfin here out in front of this, and we are going to see losses. Now, to contextualize 1%, it's a pretty safe number to put out there. Nobody's really going way out on a limb with a 1% loss in real estate prices, right? So of course, real estate is hyper local, and it's going to be very different for you. So we're going to go through some statewide California numbers and even some local California numbers to try to contextualize this even more as to what's happening on the ground where you are. But nationwide, for our folks who aren't listening from California, we're looking at 1%. And I suspect actually those numbers are going to get a little bit worse by the end of the year. My prediction would be we're going to see more than a 1% drop nationwide by the end of 2025. Now, part of that is due to the data that we're going to talk about in a minute in terms of massive inventory increases and decreases in closed sales. for the most part, but some of it is also due to consumer confidence, right? So we're a confidence-based market, and there's very little confidence out there at the moment, mostly due to the trade war and the tariff business making and the overall job loss, making people really fear for their cost of living, for their ability to have a job, and for which direction our country is going financially, whether or not we're going and heading for a recession. Spoilers alert, I think we are. But that is really shaking people's confidence. So here we have a Gallup poll, and they have basically said that 1/3, or actually less, unfortunately, less than 1/3 of non-homeowners expect to buy a home in the next 5 years. That's a big deal. This is our future buyer pool saying, no, we're not here for it. We're not planning to do this right now because we are feeling financially insecure. That's a big part of what's driving all of this expectation of prices going down. Further down in the article, they also cite right here that 72% of Americans are saying it's a bad time to buy a house. 72% of Americans saying it's a bad time to buy a house. Whether they're right or not, and we're going to get to that in a minute, it doesn't really matter whether they're right or not. If that's what they believe, then they're going to keep their money stuffed in a coffee can at home, and they're not going to buy houses. That's going to make our inventory go up and our prices go down. And we are already seeing that in the data. So let's pull up some quick data to look at, and we'll clear those lines for you. So this for Santa Clara County, one of the major counties in California. And also, by the way, one of the more resilient counties in California when it comes to getting hit by some of these financial swings. You can see they are showing year over year a 6.1% increase in median home price. That sounds good. However, they're also showing home sales up by 2.6%. And again, that sounds good. But when compared with or lined up with the fact that the unsold inventory is up 26.7% year to year, you can see that's a pretty bad delta. For the market to be chugging along as it was, we'd need those sales up here to be pretty equal to the increase in inventory for the market to be staying pretty healthy. But no, we've got 26% up in inventory, 2% up in sales. So we've got a 24% delta, 24% extra inventory there showing in Santa Clara County. And when we have more inventory and not enough buyers for it, that puts downward pressure on prices, basic supply and demand curve. And we'll see this continue sort of throughout California. Here we have San Francisco. Remember, San Francisco is both a county and a city all in one. But this is for San Francisco County specifically. They're marking this data county. We are down 1.1% year over year in terms of home prices. We are up year over year just 1.4% in terms of closed sales. And we are flat year over year in terms of inventory. So San Francisco here being pretty resilient. We have sales up and we have inventory flat. That's not bad. This is doing better than most places in California, as you'll see, but they did post up this 1.1% year to year price decline. So they're not immune, but they are much more resilient. In fact, those of you with a little bit of gray in your hair or your beard will remember during the Great Recession, they never actually classified Santa Clara as a declining market. It did have losses, but it didn't get nationally recognized as a declining market because it can be that resilient during these times. Although people are kind of fleeing the city to the tune of like a 36,000 person net loss over the last 5 years. We got a video coming out on Saturday about that for you. And then next Saturday will be a follow-up video as to where those people are going. So if you're watching from San Francisco and you're wondering why everybody's leaving and where they're going, and you happen to be noticing that it's all the young people leaving and the older people staying, that is something we're going to be talking about. So you can decide what's going to be best for your family there for our San Francisco folks. All right, Alameda County here, we've got same kind of situation. We are down 3.6% year over year, price-wise, median price-wise. We are down sales-wise, and we are also way up inventory-wise. Year over year, inventory up 92.9% in Alameda County, while the sales are down 2.8%. You're talking about a 95% delta there. It's bad. It's bad in terms of inventory versus closed sales in Alameda.
Rich, you may not know this off the top of your head, but what does that look like roughly in number of units?
Units for, they didn't give us the units here, but I
Okay.
do have the units on another graph coming up.
Okay.
But it does represent about only still 2.7 months of inventory, which would traditionally still be considered a seller's market. So if the rest of these trends weren't showing overall softening, all of them weren't showing softening, then this wouldn't stress me out that bad. 2.7 months of inventory, not too bad. But it's this massive year over year increase that is sort of the canary in the coal mine, the harbinger of bad news ahead. But yeah, I have a graph coming up that'll show us units as well. And here we have Los Angeles County. Again, we are at a little bit of an increase year over year, price wise, not too bad, but we are down in sales 2.6%, and we are up 38% in terms of our inventory. Sales down, inventory up. You see in the statewide trend here, folks, it is not good. We have more listings coming to market and people aren't gobbling them up. Sacramento County. So we're getting local here to Dave and I's market. Sacramento has been over the past few months showing some resilience. We are still technically up 0.3% year over year. I'm going to call that flat. Closed sales, though, are up 6.2% year to year. Not too bad on the closed sales. But again, the inventory is going to tell the tale for us, and we are up 33% when it comes to inventory. So up 6% on sales, up 33% on inventory. That's still a 27% delta, going the wrong direction there. And that's going to keep that downward price pressure. All right. We now have El Dorado County. This is where I live, where I do the majority of my real estate work. And the numbers aren't great, folks. Strap in here for El Dorado County. We're posting up a 10.8% year to year decrease in property value and median home price. We're showing a 3.2% year to year decline in closed sales. And when it comes to inventory, we are up 41% on inventory. So numbers for El Dorado County aren't great. You'll see some other, when we get into the next charts, you'll see some places like Placerville up 70% year over year in terms of inventory or more. All right, so let's jump into those. We're almost done with the numbers, folks. To give you a sense where you're coming from, we are in Santa Clara County here again, and this is just showing you the overall inventory. So a positive number shows inventory being up year over year. Anything in green with a plus sign is inventory being up year over year. And so this is all of Santa Clara County being shown right here. And as you can see, we're talking all but one are in the green. So we're talking, countywide up 50. So statewide up 61% inventory for California, countywide 58%. San Jose up 81%. I'm selling a family home in San Jose right now. Inventory up 81%. Morgan Hill up 76%. Cupertino up 108% in terms of inventory. The only one hanging in there is Mountain View, actually down 17.4% inventory. I don't expect that number to hold, but we'll see in next month's update. Same here. We have San Francisco. Again, it's a city and it's a county, and it's all inventory up 11.3% for San Francisco. Now we'll go to, I believe we've got LA coming up here. Yep, Los Angeles County. Again, you can see in this column, we are looking all in the green, all up 61%, 78%, 40%. 4.6 is about the lowest that it's up anywhere, but most places are up over 30% in terms of inventory in LA County. Here we have, where are we? Sacramento. So getting local again here. And although Sacramento has been, as I said, fairly resilient, we're still looking at only two places, North Highlands and Rio Linda, showing a decrease in inventory. Every place else showing a 17% or better increase in inventory, with some rough spots being Gold River area, Gold River area, and then Rancho Cordova, 68%, 178% Rancho Murrieta, and even just Sacramento, downtown Midtown area, 60% right here. So the numbers aren't looking too great in Sacramento. And our last one here is going to be for El Dorado County. Like I said earlier, unfortunately, The numbers for El Dorado County aren't looking that great. So we've got green all the way, except for Pollock Pines. Pollock Pines, negative 4.4% for the year, but up 61% for the state, up 46% for the county. And every place, the lowest is South Lake Tahoe, up 21%, but most everything is going to be 40% or better up in terms of inventory in those marketplaces. So when it comes to why Zillow and Redfin are saying that we're going to have price declines, it's because of those inventory numbers. Those are posting up massive inventory gains. So now we're going to get into interpreting those numbers for you. Do we actually think it's a not great time to buy, or is there a better way to approach this thought process? So if you're looking at prices declining by 1%, that's not really going to be a whole lot of money on your average home at a $500,000 price point. So if you had committed to buying a home this year for personal reasons, you need a bigger home because you're having another kid, you need to move closer to the grandkids, you're retiring, you need to move out of state because there's a cheaper place for you to live on a fixed income, then these are not real reasons to stay on the fence in terms of buying your next property. All those reasons you might sell usually come with a purchase afterwards of a new home. And I wouldn't be shying away from a have to purchase because of a possible 1% decline over the course of the year, although I do believe it'll be a little higher. However, if I was a first time home buyer, really strapped for cash, putting everything I have into this and scraping by to just barely make it, I think now isn't the best time for you. I think it is a reasonable choice for you to pump the brakes and wait for a better opportunity. And this is going to present opportunities. We are seeing the tip of the iceberg here. We're seeing the numbers that say that declines are going to happen. Once the declines actually happen, we're going to have a reset in affordability. I hate to hope for this sort of thing, but in some ways, I hope it's better than 1%. So a lot of our folks in California who haven't been able to buy a home can buy a home. So if you are someone who's been thinking about buying a home, you're maybe priced out right now, or you're on the ragged edge of affordability right now, now could represent the best buying opportunity. If you're an old guy like us in your 40s or 50s, this may represent the last best opportunity to get into the market at depressed prices. Maybe you weren't in a financial position to take advantage of the low prices in the Great Recession, and then you got wildly blown out and priced out in COVID. Here's a chance for a reset. So for those of you, I'm not saying run out and buy a house right now. I'm saying it's time to get prepared so you are ready to jump in and take advantage of these opportunities. There's different ways buyers and sellers can get prepared because, of course, our sellers will be buyers once they sell. So, Dave, can you walk us through the number one and most important thing for people to do to just be prepared and have their ducks in a row while they're sitting on the fence so they can jump on an opportunity when it comes?
Yeah, this sounds self-serving, but talk to a mortgage professional and
Yeah,
we will
agreed.
go through the most critical things that a potential home buyer needs to pay attention to. And that is, your credit score, your job security, income, looking at debt to income ratio, analyzing debt, seeing what that might look like. And I think when we talk about this in general, like what we're doing, and as you were going through and you were showing the price declines, and it's not a significant, on a $500,000, no one wants to lose 5,000 if they went down 5%. But I look at all the folks that maybe bought a home in the last 10 years or 7 years, they are up significant percentages. And maybe we do a podcast on that says, hey, if you bought in 2018, here's how much you're up. If you're down 5% this year, you're a net up 60% or whatever that looks like, right? Like, because those are the folks, like if you have lifestyle reasons to sell or to move, like let's not wait. Let's, get your house ready, put it on the market. Because we just don't know how long this is going to take. We talked about the July perfect storm, but the more at the rate that inventory piles up, the longer it's going to take to get through that inventory. Obviously, some folks will decide they're not going to sell their home or whatever they may do. But I think with folks that, you want to be closer to grandchildren, or you just want to downsize, you're going from a 2-story to a single story. Like, don't, my opinion is don't wait out the market just to squeeze out the last, 2 or 3%, price it right. sell it. You got tremendous great gains over the last 5, 7, 9 years. You're way up. So just because you're down maybe 5% or 2% in the last year, you're still up net net. So I just wouldn't want anyone to be paralyzed and just sitting and waiting for the market to come back and go back up in value till you sell again. If you have a life circumstance reason why you want to sell
Yeah,
and buy.
particularly in a declining market, if you're downsizing, if you're the grandparents, selling the big house and moving into the smaller house, well, you're going to lose more money on the big house by waiting for the losses than you'll gain on the little house. 1% of your $700,000 house is, more than your 1% of your $500,000 house you're going to be buying. So you lose more by waiting in that regard. But for the buyers who are sitting there and thinking, well, I am going to wait for these price drops because I have to, because this is my one chance to get in. For you guys, that first step of calling a lender is crucial, and figuring out the landscape of how to get yourself in the position to write an offer instantly when that home you want comes up. That is the work to be done right now. So even though you may not be feeling confident about buying a house right now, even though you may have been priced out, there's still work to be done. Don't let the news media have you disengage from the housing market. This is a time to really engage, get qualified, and then go ahead and wait. Nobody's saying you got to do it now, but be ready.
Right. And Rich, you bring up a good point, and I have these conversations all the time. Just talked to a joint mutual client last week that, their timeline might be a week, it might be a year. And that preparedness to be prepared to buy, that lasts as long as we stay in regular contact once every 2 or 3 months, unless there's major changes or you're contemplating major changes. Pick up the phone and say, hey, Dave, I'm thinking about buying a car. Is this going to affect my purchasing power?
Yes.
So I don't have to run your credit today. We need to have a conversation, see where you're at, see where you want to buy. I recommend that if you are going to look to buy in the short term, we look at your credit, make sure there's no surprises. I know we got a lot of stories about that we could, take sidebar on, but it's okay to get prepared and know that 6 months, a year from now, that general pre-approval, if you've had no major changes, no job loss, no major debt acquisition, that's relatively going to hold true. It's really easy to refresh. Takes minutes to just update that data. So do it now. And then, a lot of people are shocked and surprised to say, oh my gosh, I could actually buy now if I wanted. And that's starting to become affordable. And, we've been in this market a lot, Rich, or we've seen the ups and downs, and, someone that 1 or 2 or 3% in values coming down makes it, the ability for someone to maybe even buy a little nicer house than they could have 2 or 3 months ago.
100%.
Those opportunities are opening up.
I remember in the Great Recession, I got in the business in 2005, and the market had already shifted, by late 2005. And then the big crash with Lehman Brothers, whatever, 2008, people market different places. But, being new in the business, I wasn't in a position to gobble up rental houses or really good deals for my family. We did buy our family home and get a good deal on it during that time period. But I remember Warren Buffett at the time saying, if I could buy 300,000 single family homes right now at 30-year fixed mortgages at these rates, I would do it. And he said, I don't have a functional way to do it. So we started a real estate brokerage instead, Berkshire Hathaway Brokerage at the time. But a lot of us, due to job loss or whatever, or just the age we were when that happened, weren't in a position to take advantage of those opportunities. And so what we want is for you guys to be in a position to take advantage of those opportunities this time. So do we agree that now is a bad time to buy a house? Well, there's no blanket real estate advice that's good advice, right? So no, now's not a bad time to buy a house, but it might be a bad time for you. Like we said, if you're one of these people that needs to sell and buy because of a life circumstances, there's really no reason not to do that. If you're the buyer on the ragged edge of affordability, sure, now's not a good time to buy, but it is a time to be very tuned in, very prepared, and ready to jump. Now, mortgage originations, as Dave let us know last month, were down pretty significantly for new mortgages. And that's another indication that the buyers aren't really trying to come rush right out and gobble up all these listings. But we are seeing an uptick in another type of lending, Dave, that will help our sellers who are preparing to sell and then buy. Can you talk a little bit about what we are seeing a rise in right now?
Yeah, and it's we're seeing a huge demand in home equity lines of credit. You hear the term HELOC, which is home equity line of credit or a second mortgage, and there's adjustable rates and there's fixed rate second mortgages. And a lot of folks, and I've been doing this a long time, and so over the years, when people typically see moderate appreciation in their home and interest rates staying pretty stable or stagnant, or maybe just moving up and down slightly, they would typically refinance that mortgage, pull money out if they had increased equity, pay off revolving debt, do some home improvements. And basically what they were doing is just extending the life of their loan. If you did a loan 5 years ago, you refinance today from a 30-year to another 30-year, you're adding 5 years to the life of the loan. But most people aren't worried about that far down the road. And you had a fixed rate, you knew what your payment was going to be. But by extending the amortization period, oftentimes you could take money out and your payment would stay the same or even drop, and you're getting rid of some consumer debt. Well, with where the current rate environment, and we're still in that very high 6, low 7% range. Folks that have that lock-in effect that are in the low 4s, 3s, some even high 2s. They don't want to touch that rate. So they've built equity over the last several years. And so you have the ability to do a home equity line of credit. And that's also part of that preparedness that we're talking about. So if you're someone that wants to, maybe sell your home and sell it in the relatively near future, if there is a lot of inventory, significant inventory, and inventory continues to go up, that's the time where we may say, hey, if you have opportunity to not only pay down some debt, take a home equity line of credit, but also do those home improvements to make your house the nicest house to sell when you're ready to sell. Get it, get yourself positioned that if you kind of have a time horizon window, um, you want to create a competitive advantage where, 2 years ago, you didn't have to have the nicest, shiniest house. And we're going to start seeing that kind of come back where,
Yeah.
and it doesn't have to be a fortune. We're talking paint, carpet, maybe spruce up a few things that, you could probably look on your street or your neighbor's street and see what houses look like. They're in your price point and know what do you need to do to make your house, slightly more attractive than what your competition is.
Yeah, I think that's a really good point. And for you people who are considering selling, and then you're going to have to turn around and buy, but you may want to buy first and sell second, like most of us do, because you don't want to give up your home. And speaking of which, we have a whole podcast episode on how to do that and the pros and cons of different ways to do that. So you can click on that in the Informed Homebuyer podcast playlist. And if you're getting anything out of Dave and I rambling on about your real estate decisions, we really appreciate if you hit a like, hit the subscribe button so you don't miss the next episodes. They're going to keep you informed of when might be the time to decide to get off the fence. So make sure to hit those buttons down below and that little bell icon that makes sure you get all the notifications. But for those of you who are considering doing this and you want to buy first and sell second, you need to be in a position to list your home in 48 hours, 72 hours, 5 to 7 days at the outside if you're going to run around splashing around contingent offers on things. And part of being able to do that means having the home ready before you start looking to buy. And that's where this HELOC idea comes in, figuring out a couple of those projects you need to do, and then bringing in the money to do that. And also, and Dave, maybe we can talk about this a little bit, and don't go playing around with this without getting advice from your trusted lender. So if you're in our market, Dave can do loans in the entire state of California and Nevada. So call him. If you're watching us from anywhere else in the country, thank you so much for being here. Reach out to your trusted professional near you or ask us for a referral to a trusted professional out there. But don't do this without talking to a lender first. But when you're going to buy, your credit may be a little bit lower, your debt to income a little bit high, even with the house coming off. There may be some massaging of your ratios you need to do to qualify. So paying off debt is another thing people do with the HELOC money, right? To prepare for their
Yes.
purchase after their sale.
Yep, that is correct. And so, and we see this all the time, consumer debt or even like an auto loan. You might have a short amount of time left on that auto loan. When you sell your house, maybe that HELOC's going to go away. You're going to pay that off, depending on how much you're going to put on the purchase on the new price. But just your monthly outflow can greatly be reduced if you do things properly. And especially if you have high interest rate debt that is just, you're not really chipping away at it. You're paying bulk of that's interest versus principal. you may want to consider this and just, it's simultaneously getting rid of debt. It's going to improve your debt to income ratio so that you're in a position, especially if you're a contingent buyer, that you may even buy before you even sell your house. What we would definitely dig way deeper in that, because the last thing we want someone to do is buy a house or put your house on the market, accept an offer, and then you're not going to qualify for that next house. So
Yeah.
we want to make sure we have those conversations as well.
Yeah, and I think a good place to wrap this will be just a quick update on interest rates. We've been pretty consistent on this for months and months, talking about what we think is going to happen. We've got Redfin agreeing with us. Dave, where are we going interest rate wise for the foreseeable future?
Yeah, I sound like a broken record here, Rich, but looking at the economic data that's coming out, and the best we could do is look, week over week, maybe month over month, and try to identify, okay, when's the Federal Reserve going to meet? Is there anything trailing data that's going to motivate them to lower interest rates? Again, look at some of our previous podcasts, but their Federal Reserve, their charter is to manage inflation and manage unemployment rates. And so we're not seeing anything in either one of those that is saying, hey, we're going to see in June, we probably won't see a rate reduction in the Federal Reserve rate, but don't get confused with if they do stay the same or they do lower, that our mortgage rates are going to come down. Kind of the projections are towards the end of the year, we might see 2 or 3 quarter point drops. So 3/4 of a basis point. So, but that, looking historically, isn't going to be a 1-to-1 in mortgage interest rates. So we see that drop, we might see ourselves, trending maybe closer to 6.5 to 6.75 range. So it's not worth waiting for that. If that's what you're waiting for, don't hold your breath. And that's just until something, hate to say it, the crap hits the fan and we got bigger problems. That's when rates are going to come way down. So be careful what we wish for, right?
Yeah, and in that Redfin article, they basically agreed that they see the rate staying in the 7% range roughly through the end of the year. So we don't have interest rate relief coming. We have prices likely to come down. We have inventory on the rise, closed sales dropping. We have about 46% of the 53 counties in California reporting year over year median price declines. All of this is pointing to what we've been saying, not only the July perfect storm, where I think we have those other factors of tariffs being unpaused and financial data coming out pointing to recession that will kind of maybe accelerate some of this, but just in general, all the signs are pointing the same direction, which is price declines this year. That means if you're a seller and you've been waiting, probably a good time to come to market. If you're a buyer who has a reason you've got to buy, I wouldn't wait. But if you're a buyer who's on the fence and on the ragged edge of affordability, then I would agree with 72% of Americans that now is probably not the right time for you to buy, but it is the right time to get prepared so you can take advantage of the opportunities coming your way.
Yeah, Rich, question on that. So if you're a buyer, in your opinion, you're prepared to buy now and you have, monies for down payment and you're seeing this inventory tick up greatly, there are going to be sellers that really are in a situation that they just want to sell, they want to get out. Is there a downside to, hey, let's take a look at a property and, maybe it's listed at, I'll just throw a number out there, 700, but I'm going to offer 650,
No, not really. It's all dependent on each individual property. Sometimes there's always the risk if you really lowball the hell out of someone, they take their ball and go home, but not in a market where they have a lot of competition and not a lot of buyers. That usually doesn't happen. The only other risk is that you get emotionally invested in the house and then they won't back down and you convince yourself to come up. That is one risk. But in general, once we have these market mechanics more solidly in place, where we're saying, hey man, there's a lot of listings here, you've got a lot of competition, we're already posting up losses, we're already posting up price declines, we're in a good position to negotiate on your behalf and say to sellers, yeah, you could wait 30 days for another buyer and take your losses in the marketplace then, or you can take what this buyer's offering right now because it's the most you're going to get because the market's declining, and actually for the first time in years and years here be able to really consistently, successfully start to negotiate prices down. For buyers, that'd be lovely. It'd be a great thing to be able to say to our buyers again that we haven't really been able to say for years. And I think we are going to see that come back to the marketplace over the course of the rest of this year, which is, to your point, a reason to get all your ducks in a row. Because if you do see something you're excited about, why not go splash an offer out there? A year ago, when we're still solidly a hardcore seller's market and they're going to have 3 to 5 offers, then there's no point in going around splashing around under asking. But that has shifted, and it is something you can start to try again, which will be exciting for you buyers out there.
Yeah, and being someone that's bought and sold a lot of houses myself, is there's when you're the seller, you take it personally when someone lowballs you, right? Or puts in a lower offer. But
Yeah.
you were perfectly okay as the seller when you were getting multiple offers and you were, coming back and countering it, 5% above list price and still getting that price. So it works both ways. And so I think as long as you work with an agent like Rich, and you have a good conversation, and if Rich, you see a house that you want to put an offer on, that it's real, realistic, but you have Rich to have a conversation with the listing agent, say, hey, here's what's going on. We're going to submit an offer. Don't want to offend you, but if your sellers are anyway in a position that they want to take it, here you go. If not, no hard feelings. So
Agreed. And I think that is the place to focus your attention right now. We're not here to say there's not a lot of doom and gloom in the numbers. I showed you the numbers. They're ugly. The headlines are ugly. We're not pretending this isn't happening. What we're saying is, here's the one bright spot. Here's one place where you might be able to gain and get a little advantage out of what's going on. And if we all have to suffer through this together, we might as well get the bright spots and take the gains where we can get them. And opportunities to pick up housing at a discount are coming your way. So get prepared for that. That's the takeaway of this one. You've been with us for 36 minutes. We deeply appreciate if you're willing to listen to two middle-aged real estate professionals prattle on this long. You're either a sadist or you're deeply committed to your own financial education. Either way, thanks for being here. We'll see you on the next one. I'm Rich Curtis.
And I'm Dave Miller. Thanks.
Bye, guys.